Good afternoon, and thank you to those of you who are joining us today to hear from VP plc, who announced their interim results yesterday. We're going to hear this morning from Neil and Allison, who are going to run us through the presentation, and at the end there'll be an opportunity for Q&A. So without further ado, I'll hand over to you, Neil.
Thank you, Hannah. And, good afternoon, everybody. Afternoon. We're going to I'll take you through the highlights section and also the market and trading review, and then I'll hand over to Allison, who will talk to the financials for the 6 months. So moving on, in terms of highlights, we do expand on all of these points throughout the presentation, but in terms of the highlights, the results, we see these as market-leading profit margins that we've delivered in 6 months to 30th September 2021, and therefore very pleased with the quality of them. The results, there's been a strong recovery in trading, and that's catalysed profitable reinvestment into our hire fleet. We've seen an excellent performance, which has largely been driven by, for the most part, in the infrastructure segment, but as I'll explain later, not all of infrastructure, and also a buoyant house building market. Elsewhere, overall demand in commercial construction, civil engineering has been solid, but not particularly strong. The international division had a stable 6 months. We've made substantial progress in ESG initiatives across VP with a new roadmap to net zero, and we've focused a lot of our capital investment in new fleet, which has been heavily focused towards eco-friendly solutions. Current trading in the business is positive and in line with our expectations. And final highlight is the reinstatement of a progressive dividend policy, reflecting confidence in future trading, and the declaration of an interim dividend of 10.5p. The headline numbers, we reported revenues of 176 million, which was 24% ahead of the prior year, and the recovery has been maintained. Profits of 20.2 million were very good, and a material improvement as well, and also importantly, much improved margins. Return on average capital employed, for those of you that know us, is a key measure for VP, and that's back up towards our target level at 13.5%, and it's pleasing to see earnings quality return as quickly as it has done. Net debt increased by just under 10 million, but that's after spending 32 million pounds on new fleet in the 6 months. Just the next two graphs are a reminder of the long-term growth trend that we have within the group, which has clearly been impacted in the recent times by the COVID pandemic. But I think it's important for observers to see how strong our long-term growth trend is. The interruption of that started in full year 2020, which is year ended March 2020, where the March trading was very impacted by the start of the pandemic. The full year 2021 includes the worst, we hope, of the pandemic scenario, and what we've shown in the final column is the consensus between our two joint brokers, Singers Berenberg, of revenue recovering to circa 355 million in the full financial year. The second graph, and perhaps even more importantly, is the profit graph, which again shows similar trend, good profit growth, interrupted by a very disruptive year last year, and with an expectation that we're recovering a significant proportion of that shortfall in the full year. On to market and trading. The core markets slide is an important one in understanding where VP are. We have seen not too much change in this over the last few years. Infrastructure markets represent about 40% of our group revenues, and construction a very similar figure, and another 40% effectively. All markets grew, which you would have expected as things improved. But within those markets, there were some different dynamics happening. So within infrastructure, which is generally defined as regulated markets, we've seen a mixed recovery. We've been very busy on HS2. We've also had good revenues from the transmission sector. But by contrast to other very large regulated markets to which we are major suppliers, the AMP water market, the AMP7 programme, and the CP6 rail programme have both been slower to pick up than we might have expected. So we see that with the HS2, we see that as continuing. We've had good activity in that area, and that's something that will continue. We hope that the AMP programme will pick up, if not in this financial year, certainly materially in the next financial year. The rail market, we've already seen some signs of improvement. In construction, again, a mixed message there. We've got construction RMI, so the repair and maintenance has been very strong, and we've benefited from that. But I think the lack of confidence in private investment in speculative construction has held back the new build area of that construction market. And that's another area of potential improvement for us going forward, but not being more GDP and business sort of economic confidence led rather than regulated, that may take longer to come through. House build has been excellent, sustained demand in the house build sector. We see that continuing for the foreseeable future. And in energy, we have seen positive activity on onshore rather than offshore in terms of maintenance activity. So overall, our core markets are recovering, but there's still a lot of potential to come. The group figures, good revenue growth on COVID-19 year at 24%, and also significant improvement in profitability, which has more than doubled. Margins at 12.8% are, I think, very good and heading back towards where we were pre-COVID. I make the point that incremental revenue conversion, the drop through from that incremental revenue, is effectively at a margin of 35%. So it's very much about understanding the operational gearing effect of a business like ours, which has a lot of fixed costs and latent earning potential in its fleet. If we can put more revenue as markets grow, then the conversion into profitability can be disproportionate in our favour. And finally, the strong performance for the year, but potential as other markets achieve fuller recovery, we hopefully will be able to deliver further progress going forward. The UK's division is effectively the engine room of VP. It's by far the larger element of our operations, and we've had a very good first half in the UK. I think that the revenue growth of 25% maybe might have been expected, but we've been able to deliver that, convert a lot of that into growth and profitability, and margins at 13.6% are certainly very close to where we were pre-COVID. So we've already restored the quality of our revenue streams, even if we haven't fully restored our revenues to full pre-COVID levels. I've talked about the markets in the core sector slide. In terms of the influence on the UK business, The HS2 activity has been beneficial to our TPA, our ground force and our ESS businesses in particular, with good demand both on both the enabling and the construction phases of the HS2 programme, which is of long-term in nature. By contrast, AMP7, which is the 5-year water capital investment programme, that started in April 2020. We've seen very little growth in that so far. We're hoping that that will start to pick up in the new financial year, in the new calendar year and heading into the new financial year. It won't be a step change in activity, it will be a gradual build-up, but that's an opportunity for us. On CP6, which is the rail industry's long-term investment programme, that was a bit slower in the summer than we might have hoped for. But activity, in contrast to AMP, we have seen rail activity pick up in the second half of the year already. And Torrent in particular have been very busy working on both the east and west aspects of the Transpennine upgrade. And we've got a confidence of further growth in those markets in the new calendar year. Moving on to construction, the RMI, the repair and maintenance activity has been very good, in particular for our Brandon and MEP businesses, and that's something which we see as continuing. Again, in terms of weaker but equally potential opportunity going forward, the new build market has been quieter and major projects have been less, and that's produced a subdued civil engineering market, which in particular impacts the rate of growth in our ground force division. In house building, it's been a busy sector, very good for UK Forks. It's a rare time, but we're seeing demand is outstripping supply in that sector in terms of the UK Forks products at the moment. And lead times, the reason for that is lead times for new equipment stretching out as far as 12 months. Although we have pre-ordered our requirements, minimum requirements for the next 12 months anyway, but that's creating a very busy rental sector supporting the house building market. And then finally, as we've reported last year, we made a lot of cost savings in 2021 during the COVID pandemic. And those cost savings, I'm pleased to say, have been materially maintained into 2022 and that is undoubtedly a factor in the recovery in operating margins so quickly in the first half of this year. Moving on to international. International is much smaller. It's been disproportionately impacted by lockdown action in all the jurisdictions within which our international businesses operate. So we have seen lockdowns in Australia, New Zealand, Malaysia, Singapore. They've affected both our TR and our airpack business. So this pace of recovery, particularly in profitability terms, there has been less. However, despite the weekend's news about the Omicron strain, we're hopeful that clearer waters next year will see both those businesses lead a recovery back to some more normal levels of profitability. In terms of rental fleet investment, it was a strong investment period. We spent 31.7 million, which was well up on prior year. Probably three areas to focus in terms of that. One was as I mentioned in the highlights, the investment into improving trade opportunities. The second is in terms of lead time. So we've had to be proactive in making sure that we can guarantee a supply to our customer base over the coming months and throughout the rest of the year. And thirdly, we've also put some anticipated growth investments. So we've invested into some of those markets, such as supporting AMPs, supporting the rail sector, in advance of that full recovery coming in. And on the basis, we expect those markets to recover more strongly in 2022. I've got a separate slide on environment, but there was a strong emphasis on eco-friendly product substitution. And we are engaging with both the manufacturers in terms of new and better and more environmentally friendly and greener products. And we're also engaging with our customers in helping them with the same journey that we are on in terms of trying to reduce our impact on the environment. My final comment on rental fleet investment is that not only did we spend nearly 32 million in the first half, we'd also ordered an additional 20 million by the end of September for equipment that will be delivered largely in the second half, but actually some that may still drift into our next financial year. Again, reflects the supply chain issues that we are faced with. So on environmental, we have made a lot of progress in this area in the last 6 months. We've committed to the Science Based Targets Initiative as a business, and we have developed a roadmap in terms of how we're going to approach our response to that initiative. There is a long-term roadmap, but more importantly, we feel that we should be focusing on the short term, which is the next 4 years. And actually, as an appendix to this presentation, there is we share what our roadmap looks like as a business. I mentioned that we've been investing into new products in the rental fleet. There is a vast range of those products that have been purchased and are now being used by our customer base. The selection would include solar panel lighting fleet. Our Torrent Trackside business invested in the largest solar panel lighting fleet in the UK to service their rail customers during the half. We've invested in a huge range of substitutional cordless tools, which will replace tools which have been diesel or petrol driven for many years. And that's been a relatively seamless transition, which has been very encouraging. We've also bought electric compressors, electric telehandlers, and also electric mini excavators, all of which are growing in popularity with our customer base. And finally, we started to operate hybrid service vehicles within the fleet. So it's a significant impetus in that area. Other initiatives, we're committed to achieving ISO 50001, which is the International Energy Management Standard. This creates the framework around which we will build our environmental response. We have some good examples of water recycling at certain depots. We're introducing solar panels onto some of our larger sites. We're 95% users of renewable electricity, and there is now a hybrid car offer within the company car fleet. Another element is biodiversity. We've invested into 3 nature conservation projects in the last 6 months with the likes of the Yorkshire Wildlife Trust, Nottinghamshire Wildlife Trust, and the Flora and Fauna International. And these are aimed at peat bog restoration, rewilding, reinstitution of meadows, and also marine conservation. So some important, small but important contribution from us. And pleasingly, there are colleague engagement opportunities within our employees. It's probably important to point out that a lot of our existing equipment, whether they be aluminium portable roadways or steel shoring or aluminium tower in our tool hire business and MEP, they are zero emission at point of use. So yes, there is output environmentally on the making of the metal, but once we have that product, there are no engines, there is no fuel usage in there. And my final point is even more fundamental, that we believe that rental as a concept has very strong eco-friendly credentials in that we optimize the usage of shared resources. So our existence allows all our customers not to all have to earn one each. They can share the usage of that by us maximizing the utilization and raising it out. So that's our environmental initiatives for the year. My final slide, before I hand over to Allison, is on outlook. We continue to deliver market-leading quality of earnings. You've seen the slides that I've shown on revenue and margin. Allison's got a slide on return on capital. These are very good performance metrics for us. We anticipate an acceleration of AMP7 and CP6 activity, which will provide large opportunity to us. The only slight doubt is whether that's going to be in the next 3 to 4 months or whether it's in the next 6 months. And then there's further upside if and when economic and business confidence grows sufficiently to allow an acceleration of commercial new build investment, which is obviously also going to be a useful benefit to us. I mentioned HS2 already. It is a long-term opportunity. Our engagement with house builders is that the next 2022 is going to be just as busy as 2021. The sustainability initiative on environment I've talked about, it's understood across the business. It's become part of our day-to-day language, which perhaps it wasn't a couple of years ago, and it is providing vital customer support. Investment in technology has remained strong, and we have been always continuing to introduce digital solutions, both for our customer base, but also in operations alike, so to better inform our own teams within the business. We've also revitalised our learning and development initiatives as a business, investing in our people. We've had a new intake of engineering apprenticeships, but we've also opened up in terms of sales apprenticeships and LGV driver apprenticeships this year, added to which we've had another intake of graduates in September. Prospects in the UK and international divisions both remain positive. I think the combination of our financial strength and the exceptional team of people around the group and with all its experience and knowledge will deliver results going forward, and we remain confident of reporting another year of tangible progress in the coming full year. So that's all from me for now until Q&A, but I'll hand over to Allison who will talk to the financials.
Thank you, Neil, and good afternoon, everybody. So my first slide is the financial highlights, which serves to reprise some of the points that Neil's made and the fact that we've had a strong and continuing recovery in the first half of this financial year. Revenues were strongly ahead of prior year. They were up 24% to 176 million. And profit before tax and amortisation was up 135% to 20.2 million. This reflects the fact that some of our businesses are actually trading ahead of 2020, which we take to be the pre-COVID year, and others that aren't in that position because of the cyclical nature of infrastructure and some of the supply chain constraints that Neil has outlined. Skipping on to a slide on dividends, and what this slide sets out to do is to show the long-term view of our dividends, and that we have for the past 10 years, or always really, implemented a progressive dividend policy. We've declared an interim dividend of 10.5 pence per share, and you'll see that last year, FY21, we didn't pay an interim dividend, and that was due to the uncertainty around COVID. But in the previous year, we paid 8.5p per share interim dividend. So the 10.5p is a significant uplift in that. And what we're trying to address in that is twofold. The first is that we want to go back to a more 1/3, 2/3 split between the interim and the final dividend. And also we've noted, certainly on the time period of this chart, that we've been well ahead, over 3 times dividend cover, which is well ahead of our 2 to 2.5 stated policy on dividends. So the increase is signalling our intention to move back to the 2 to 2.5 times dividend cover. Key point about our business is that, and Neil's already outlined the quality of our earnings in terms of revenue and profits and margins, but we also look at return on average capital employed. And again, hopefully this chart will illustrate the fact that we've delivered strong return on average capital employed throughout the duration. We target 15% return on average capital employed throughout the cycle. And you can see that COVID did impact this, bringing us down to 9.2%. We're now recovered at the half year to 13.5 and would intend to get back to where we were previously. And this number is still well ahead of our weighted average cost of capital, which is 8%. We have a strong balance sheet, and you'll see that hire fleet is 213.7 million. This has grown year on year. We have a young and well-managed fleet. That's one of our key attributes. The average age of the fleet is about 3.5 years. We've grown the fleet in the period, and that resulted in an increase in net debt to 131.7 million. At these times of uncertainty, it always makes sense to keep an eye on debtors, and I'm pleased to report that actually our debtor days are in a healthier position than they were in half 1 2021. And our bad debt write-off as a percentage of revenue has remained at similar level. In fact, it's slightly lower than it has been for the last 18 months, although we will keep this under review, because perhaps there's more of a risk as we get into a stronger recovery period, and maybe some businesses that we deal with would start to overtrade. But hopefully that won't happen. Cash flow generation, we're a strong generator of cash. As I previously mentioned, we did have a cash outflow of 9.8 million in the period. This was driven mainly by the strong capital expenditure that we put into the business. Partly that was to meet demand, and partly, as Neil's already mentioned, skewed towards environmentally friendly assets, and also to manage in advance to deal with the supply chain issues and longer lead times for our products. Net debt and facilities, you can see from this slide that we have generous headroom against our facilities. We had 59 million at the half year. We put in place a refinance in the first 6 months of this calendar year, and that's resulted in us having long-term debt. You can see that we have 93 million, which is 6 and 7 year money on a private placement, and then we have 90 million in an RCF, which expires in June 2024, so it's fairly long dated. And the RCF also includes 20 million accordion. So in addition to the 59 million of headroom we have to allow us to grow and recover, we also have the accordion. And my final slide is that in our facilities we have 2 covenants. EBITDA interest cover has to be greater than 3 times, and you can see that it's consistently been well ahead of this. And then net debt to EBITDA has to be less than 2.5 times. And again, we're well within that range. And that is the final slide from me. So I think I will cease sharing, and then we can do the Q&A.
Thank you very much to you both for that helpful run through the presentation. And we've got a number of questions. Are you still comfortable with the 14% margin target by March 2022? And what do you hope the margin will be for the full year 23?
I think we would be comfortable with the margin for the full year at this stage. What we do know is that H2 tends to be slightly quieter than H1 in total activity terms because of December and January being shorter months. But the overall quality of the revenue should hold up in those lines. In terms of improving the margin further, hopefully that will happen. As I said in one of my slides, that the operational gearing of the business should assist in that regard. But to be quite honest, the main driver for us is about return on capital. So the most important thing for us is that we maintain and continue to close that gap that's quite small now, but that Allison referred to in terms of getting back to the sort of return on average capital employed that we target through the cycle. And again, that I think is going to be our more likely aspiration, if you like, into 2023, is that we can continue to invest in the business, continue to grow it, but more importantly, make sure that we don't dilute the quality of the earnings that we're already getting. And I think that's a realistic ambition. Some of our businesses are operating at full tilt at the moment. They're ahead of pre-COVID. And we're investing in those businesses and growing them. Some of our businesses have got spare capacity. They've got equipment that can be used, which we're already invested in, and that, if you like, is a potential free go once some of those markets I referred to that are not reopened yet, reopen. So I think that would be my take on that. I don't know whether Allison's got anything.
No, I don't have anything to add.
No. Okay.
Thank you. Well, perhaps then in terms of how you flex in terms of capacity demand, do the rental prices vary on demand? They do in the long term, but not necessarily in the short term. So it's not a dynamic pricing model on a daily, hourly basis. But what we have seen unusually, I think, in the last 6-12 months is the whole range of pricing in the market. So we've got businesses where we have invoked quite material price increases and improvements because we need to or we can. And then we've got other parts of our market which are less busy, where price competition remains very acute, and we've got everything in between. So typically with larger customers, we'll have long-term pricing agreements. So we will review pricing with them on an annual basis, and we will flex those prices dependent upon circumstances. For smaller to medium-sized customers, there isn't that discipline, if you like, of annual review. So that's a more dynamic pricing environment. Thank you. Okay, Brandon Hire, obviously a big acquisition for VP. How do you feel it's going in terms of the benefits starting to show through? Yeah, we're extremely pleased with the Brandon Hire acquisition. I think, as we've said in previous presentations, the execution of the bringing together of two successful tool hire businesses into a consolidated Brandon Hire station, I think the execution of that was by the management team there was excellent. And we've got a very well organised, well put together single business, which is now the largest tool hire business, pure tool hire business in the UK, with 160 branches across the country. In terms of the revenue synergies, if that's the right phrase, in terms of growing revenues, as I said in the core markets slide, some elements of construction are a lot quieter than others. So whilst we've been very busy in Brandon on certain aspects of the construction market, there are other areas where we are waiting for that, if you like, for want of a better phrase, waiting for that to come through. And that provides the further growth for Brandon going forward. But Brandon have had a good first half. They're ahead of their
ahead of their targets for the first half of the year, and I'm sure they'll continue to deliver a lot in that way. So no, we're very pleased with that. I think one side comment on Brandon, we paid 68 million pounds for Brandon. We leveraged our borrowing, which Allison was talking about, I think at peak we were over 200 million of debt.
Just over 2 times.
So basically we paid for Brandon now, because our debt is now 130 sort of million. So in our eyes, the Brandon acquisition has been absorbed with all the reinvestment in all our other divisions, etc. Despite that, we've been able to pay down all the debt that we took out to buy Brandon. So Brandon's now paid for as far as we're concerned.
A nice position to be in. Excellent. Are there any plans to start a share buyback to close the rating gap on other peers, especially as VP is tightly held and volumes are light?
I think the short answer is no, there aren't any plans to do a share buyback. We did do one about 10 years ago. And that was more because we felt there was an opportunity to do a buyback which was going to be beneficial to those shareholders who wanted to stay, and also gave an out for the people that wanted to sell their shares. From memory, it's dangerous, I quote a number. From memory, I think the price was about 240 pence. So that was, it was a while ago, but if you look at where the share price is today, that looked like a beneficial move, both for the shareholders that stayed. It gave the shareholders that wanted to cash in a way out, and it also had a beneficial impact on the share price. We do have debt capacity, which is waiting for us to use. We are, I think, much more attuned to being imaginative about how we mobilise our investment in the business to grow. The return on capital employed graph, in a way, is the important one. That if we can make returns of 14-15% and effectively, on a weighted average basis, borrow at 8, then the very best way for us to reward shareholders, arguably, is for us to just keep investing more capital and returning 14-15% return on average capital employed.
Okay. So, no, well, a clear answer as you can give us. Thank you. Is VP's size and early embracing of environmental practices and products giving you a clear differentiator versus competitors?
I don't think it's a particular advantage in terms of our immediate peers, in terms of size. I think we're all engaged, which is a good thing. We're all engaged in the same sort of themes. We're all trying to introduce better, greener products. I think that it's arguable that the larger businesses may find it easier to comply in terms of the cost of that switch. Smaller businesses may find the switch from, if they're finding that they need to shorten their typical working life of the fleet, which is diesel or petrol generated, for example, to transfer it to a battery operated equivalent, there may be some inhibitors to that. I think the perhaps the more interesting angle on that is that 20 odd years ago, the construction industry was smitten with some very strong health and safety legislation. And I think without a doubt, that was whilst I think everyone was scratching around saying, well, that's all very irritating, there's all sorts of traditional ways of working have got to go out the window. That, as a rental company, that gave us a great opportunity. And I think undoubtedly health and safety, which is a good thing, has also been a big plus for us as a group. So arguably there's a similar potential scenario on environmental. I don't think it's as big an opportunity as health and safety, but the need for customers to change to greener ways of working, I think if handled properly, will create further impetus for the rental sector going forward. But I don't, we've got to be smart, we've got to make sure our customers trust us to understand what they are looking for and that we can help them with solutions. And I've said it many times, we see ourselves as solution providers rather than rental providers. And we want customers to ring up asking how that we can help them with a problem. And I see the conversion from an environmental point of view to better and greener solutions for the customer as being yet another area where we can advise and hopefully as a result give our own business another lift in terms of activity.
Thank you. Your capacity overall, is it less than pre-COVID since your turnover is now 7-8% less?
You think that
is that in fleet capacity?
We don't know, but the capacity in the group is no less than it was in terms of fleet. And as Allison said, in fact, I think the book value's slightly gone up. So, and we've invested strongly. So, no, I think that the group's more efficiently set up now. So those areas where we thought there was we needed to sort of improve the structure, we took those opportunities last year. So I think we're well set to take more on board. And I think that there is capacity both financially and within the fleet to cope with that. The one area which is a constant for us is people. So our people capacity, our ability to deliver is always something that's it's not often talked about, but it's just as important as being able to afford to buy the equipment or have the equipment. Is we've got to be able to grow the infrastructure of the business in terms of management and people at the same pace as we grow the group. So that's an area that we continue to address. And in truth, it won't be a surprise to people listening. Recruitment is much more difficult this year than it was last year or the year before. So that's the hurdle there is a lot higher than it was. But we're addressing that as best we can.
Okay, and perhaps one for you, Alison. Were your fleet disposal proceeds in excess of book value?
Yes, we always make a profit on disposal of the fleet. So at the half year, it was 41% profit margin, and the full year last year it was 25%. Okay. And I think that reflects one of our attributes are that we see ourselves as good, strong asset managers. So we buy the fleet well, we manage them, maintain them well, and then we dispose of them well as well. And we don't tend to dispose of them in our own markets. We try and find alternative markets that won't pollute our little pond.
Thank you. Two questions actually on acquisitions. I mean, you spoke there how Brandon Hire has now been certainly the debt has been worked through. What is your headroom like to do something on a material scale, and what is the pipeline looking like?
So headroom on the facilities, that was back to one of my slides. So at the half year we had 60 million, and we also had the accordion to pull down. So that would have given us 80 million of headroom for growth. And we see organic as well as acquisitions as being a route to growth for us. Yeah,
it's a balance. I mean, certainly we've got the financial headroom available. Perhaps goes back to my last point about structure. We've got to make sure that we've got the capacity. I think we have got the capacity. We did a small acquisition of a very good business down in the southeast called M&S Hire just after the half year, and we were very pleased to make that acquisition. My personal view is that M&A activity will be relatively subdued for the next 6 to 12 months, and then I think there might be more activity thereafter. It's very difficult to sort of describe a typical vendor, but if someone's looking to sell their business, if they've got the choice, I would have thought they would prefer to sell, having proven that the COVID year wasn't a typical year for their trading, and that they'd like to get another year of perhaps more settled trading under their belt before they put it on the slate. So I think on that very crude analysis, that's why I think that activity on M&A will be stronger in 12 months' time than it might be in the next 12 months. That said, as Allison commented, acquisitions and organic growth were relaxed either way. They've both been very important attributes to the growth charts that we showed you earlier, and that will continue.
Another one here on M&A. Well, perhaps you already covered it. Regional M&A gap filling, I suppose that speaks to smaller projects. Do you think that the comments you've just made there regarding apathy to sell is that just as applicable on a smaller regional level?
I think it is. I think it's a similar. If you're someone who's got a 20-year established business and you're thinking about retirement, but you're not fussed whether it's this year, next year, or the year after, and you want to be trying to sell on the up rather than on the down. I think from our point of view, our appetite for acquisition is in, just to widen the discussion, would be on in the UK, in Europe, and also in Asia Pacific, Australasia. We're not differentiating in terms of where we would look, but we're looking more for adjacent growth to similar customer base rather than necessarily trying to find more dots on the map. So we're more likely to buy specialist, local, regional, or national, rather than just buy because of the specialism, not because of their location, if that makes sense. So, I think regionally can still apply. My theory still applies.
Best to sell into a rising tide. Well, thank you. That is it for the questions. So very helpful session there, and good luck for the next 6 months, and we look forward to catching up then.
Great. Thanks very much,
Thanks for
Hannah.
the questions
And
too.
thank you to all who attended.